We have developed the European Banking Barometer to paint a picture of how banks view the macroeconomic outlook and what impact they feel it will have on the banking industry over the next 12 months. The survey, now in its sixth wave, identifies the views of hundreds of senior banking executives across 11 European markets. This year's results show that bankers are acutely aware of the ongoing challenges in Europe. But despite this, more than half of the respondents believe that their bank's financial performance will improve this year, albeit only modestly, in particular in private banking and wealth.
The good news is that many banks are looking for opportunities to grow. More than half expect to launch initiatives to promote growth in 2015. That said, they're still only predicting a 1.6% uplift in ROE, and even this looks to be a stretch. Central to banks' ability to deliver better performance will be how they respond to the changing structural reform agenda. Banks will need to redefine their core activities and scale back areas of business that do not create value or provide a competitive advantage. In fact, 41% of universal banks expect to sell assets this year. And while some are looking at acquisitions, these will be highly selective and focused on strengthening their existing capabilities.
Risk and regulation continues to dominate the European banking agenda. Risk management, the combination of capital, liquidity and the leverage ratio, and reputational risk are bankers' top three priorities for 2015. As well as dealing with a complex and evolving regulatory agenda, it is critical that banks invest in technology if they want to become more agile and efficient. The fact that streamlining processes are ranked as the fourth most important issue for bankers in this year illustrates that banks understand this. Technology will also play a vital role helping banks address cybersecurity and financial crime, two areas which were highlighted by French and British banks as key areas of focus.
Further job losses are expected as banks continue to restructure and cut costs to drive future growth. Bankers also have more modest pay expectations than last year. Nearly a fifth of respondents expect pay to fall, and 10% expect a double-digit cut in pay. That said, there appears to be a mismatch between bankers' pay expectations and the importance placed on using pay and incentives to transform behaviour across the industry. Establishing new remuneration systems ranks as one of their lowest priorities for this year.
Overall, the findings from our 2015 European Banking Barometer reflect a challenged industry. The broad-based optimism about the economic recovery that we saw in our 2014 study has evaporated, giving way to a more realistic outlook. But with the banking industry taking measures to be more efficient and cost-effective, there is hope that European banks will be able to start thinking about growth and how they can deliver sustainable returns in the years to come.